Imagine waking up and seeing money hit your account while you sleep. That's dividend investing. It sounds too good to be true, but it isn't. It's one of the oldest and most proven ways people build passive income without gambling on risky trades or chasing hype. Welcome to Dividend Desk, your guide to simple, smart wealth. If you've ever wondered how investors keep earning even when they're not working, this video will open that door for you. We're talking about why it could be the foundation of your financial freedom in 2025 and beyond. So, what exactly is dividend investing? When you buy a share of a company, you own a small piece of that business. Some companies, usually well-established and profitable ones, share a portion of their profits with shareholders on a regular basis. That payment is called a dividend. It's like getting a small thank you check just for owning their stock. You're not trading. You're not flipping. You're collecting income while the company does the work. Now, how is dividend investing different from growth investing? Growth investors look for companies expected to expand quickly, often tech or innovation brands. These companies usually reinvest profits into growth instead of paying dividends. Dividend investors prefer stability over speed. They invest in companies that are mature, cash-rich, and reward their shareholders consistently. It's not about chasing massive gains. It's about steady, reliable income that compounds over time. Think of it this way. Growth investing is like planting a fast-growing tree, exciting but unpredictable. Dividend investing is like planting a sturdy oak, slow but strong for decades. Here's why dividend investing matters. When you build a portfolio of dividend-paying stocks, you start earning passive income, money that arrives without active work. Many investors use this strategy to cover bills, fund vacations, or even retire early. And the best part? You can reinvest your dividends to buy more shares. That's called the Dividend Reinvestment Plan, or DRIP. It's how small, consistent payouts grow into big portfolios over time, the true power of compound growth. Let's look at a few realistic, safe examples. Remember, this is for education only, not financial advice. First, large consumer brands, companies that sell everyday essentials like food, beverages, and household goods. They often have decades of consistent dividend payments. Second, major banks or financial institutions. They typically share profits with shareholders regularly when the economy is stable. Third, utility companies. Power, water, and telecom providers often pay reliable dividends because their services are always in demand. These kinds of businesses tend to have predictable cash flow and steady payouts, perfect for long-term dividend investors. Now, here's the real secret: consistency. Dividend investing isn't about getting rich overnight. It's about getting richer slowly, safely, and predictably. When you reinvest your dividends, your income snowballs. Each year, your portfolio grows a little larger, and so do your payouts. Eventually, you'll reach the point where your money truly works for you. That's what we call financial freedom through dividends. So to recap, dividend investing means owning shares of companies that pay you regularly. It's different from chasing growth stocks because your focus is on steady income, not short-term hype. And while it takes patience, it's one of the most trusted, time-tested wealth-building methods out there. If you're ready to learn how to start your dividend income stream, subscribe now to Dividend Desk, and let's grow your passive income together. Subscribe for more simple investing guides, and stay tuned for the next video: how to earn $1,000 a month in dividends step by step. This is Dividend Desk, helping you make your money work, even while you sleep.